the problem with the US banking system is that the US banking system is actually potentially quite fragile. And the issue today is that what you've got is it's not so much a situation where loans are going bad and the regulators or the Federal Reserve are saying to the banks, look, you're completely foolish, you're making lots and lots of bad loans. They may be, who knows? But that's not the issue. The problem is that they can't get proper funding. And the reason they can't get proper funding is to do with constraints within the system.
On today's episode of What the Finance podcast, I have the pleasure of welcoming back Michael Howell, who's the founder and managing director of CrossBorder Capital. So, Michael, thanks for joining the podcast today.
Great pleasure. Good to be here.
No problem. And yeah, our last interview was a great introduction, I think, into sort of your work, your definitions and key insights into liquidity. So if anyone's interested, I'll put that in the description below so I can get an understanding about that. But since we last talked, a lot has happened in the market, and it's crazy to think what we've seen. So I guess normally what we'd see is increasing interest rates. Borrowers would be the ones who are squeezed, but it's almost been the reverse, where the banks have actually felt a lot of the brunt, especially a few like SVB and other ones in the US that have collapsed. So in your opinion, why has this been the case, and what does this suggest is happening?
Well, I think the first thing to say is that hold the thought that you've just presented here. Why is it the higher interest rates are not really affecting borrowers so much? They're affecting banks. And that really is a key question, which really goes to the heart of the problems within the international monetary system. And what it basically tells us is that what we've got out there are funding problems. Okay, this is not a straightforward issue about interest rates are too high or whatever. This is basically the problem that financial intermediaries such as banks find it very, very difficult to fund themselves. Now, that comes back to the heart of the issue that liquidity is the problem. And we've got to focus on liquidity and not so much interest rates. And the reason that these issues come to the fore is the very fact that we've got this huge debt mountain out there that basically people have to live with, and not just live with, but refinance or refund continuously. And I've made this point probably in the last video, is that the world financial system is no longer a new financing system where they're financing capital expenditure for future growth. It's actually a refinancing system where debt is really the paramount factor. If you've got a world where, as we have, you've got $350 trillion of debt, and that debt has an average maturity of about 5 years, it's telling you that there's about 70 trillion of debt to refinance every year. That's about 3/4 of the size of world GDP. And that's purely the refinancing element. Now, you need balance sheet capacity to do that refinancing, and balance sheet capacity is liquidity. And that's the reason that we put this paramount importance on liquidity in the financial system. Now, just as a benchmark, how much new financing actually goes on in the world economy, capital markets globally raise about $10 trillion for new capital spending, okay? So what you're looking at, you're comparing a 70 trillion number of refinancing with a 10 trillion number of new financing. But the textbooks ignore the refinancing, and they tell us that financial systems are all about new financing, and therefore interest rates are the key importance. They're not. If you're talking about a refinancing world, it's liquidity, not interest rates, which is dominant. And refinancing crises, which is what we're seeing all the time, and the problems in the US secondary banks and with Credit Suisse is all about refinancing problems, not interest rate problems. That's the heart of the problem. Will it get worse? It may well get worse, but central banks seem to be on top of it, and central banks will be forced, as they're always forced, to add more liquidity to the system. And as liquidity moves into the system, liquidity tends to be fungible, and it spills over into other areas, such as rising asset prices, and ultimately or potentially higher inflation down the road.
Yeah, so you mentioned Credit Suisse there, but then if we go back to SVB, was that sort of a similar issue of refinancing, or was that something else entirely?
Well, I think all these issues are connected, and the problem with the US banking system is that the US banking system is actually potentially quite fragile, and The issue today is that what you've got is it's not so much a situation where loans are going bad and the regulators or the Federal Reserve are saying to the banks, look, you're completely foolish, you're making lots and lots of bad loans. They may be, who knows? But that's not the issue. The problem is that they can't get proper funding. And the reason they can't get proper funding is to do with constraints within the system. So if you take SVB has basically been relying on repo financing, okay? Well, I mean, as many banks do. So what they're doing is they're basically investing in a portfolio of securities, be it government bonds, and they can be repoing those government bonds to actually raise additional finance aside from traditional deposit funding, okay? So if you think of how the banking model has changed, basically 25, 30 years ago, the bulk of funding for banks came from fairly dormant or docile retail deposits. And those retail deposits were sticky, and it enabled the banks to actually go off and fund whatever they wanted to for long periods of time. So they could issue mortgages or corporate loans or whatever. The problem is nowadays, particularly since the global financial crisis, banks probably get something like 50% of their total funding from deposits, these sticky deposits. And the other 50%, they have to go out into the market and find from the money markets. And the easiest way for them to fund themselves in the money markets is through what are called repos. And they're basically collateralized borrowing against baskets of securities. Now, if those securities maintain their values, then it's probable, or let's say more likely, that repo financing can continue to roll. So it'll have to be, redone. I mean, it's term financing. It may be, as short as 14 days or 7 days or whatever, but it can be rolled if that security basket maintains its integrity. If the value of those securities drops, or the haircut that lenders apply to that basket changes, then it's going to be a lot more difficult to roll those positions, and therefore you get funding problems. Now, the issue that many banks have had is the disruptions in the core collateral markets that you basically saw beginning around September of last year, triggered by the British gilt crisis. Okay. Now, the British gilt crisis was clearly a calamity for the UK, where gilt yields spiked higher, and that caused a number of problems, not least for insurance companies. But it basically, triggered, let's say, a lot of concern among policymakers, and it caused the Bank of England to step into the market, try and pull yields down again. Now, the question to pose is, had that same event occurred in the US Treasury market, where the US Treasury bond and note is a much, much more important source of collateral than British government bonds, there would have been a global financial crisis without any question, right? And from that point, what you started to see were governments moving in surreptitiously to their fixed income markets to try and calm things down. But notwithstanding, there still had been problems through the year whereby a lot of US banks had suffered losses on their bond portfolios, okay? As I say, it could have been a lot worse had it been a British gilt-like crisis, but it was still bad nonetheless. And banks like SVB suffered losses on their bond portfolios, which meant that they were effectively impaired or potentially insolvent in terms of their balance sheets. And that made it more difficult for them to raise new funding. And not just in terms of retail funding, but you may also have got the risk that deposit funding could start to move away. And that was actually what the problem was. So actually, these sticky depositors became spooked by events, and they suddenly started to, I don't know about run for the door, but walk for the door. And so you've seen this sort of significant exodus of deposits from US banks. Now, that's been made worse, and this is getting slightly detailed and a bit wonkish, but it's been made worse by the structure of interest rates in the US, whereby banks are actually paying relatively small amounts of money for depositors' cash, but the Federal Reserve is paying much higher interest rates to actually absorb liquidity out of the system to try and maintain the current structure of interest rates. And money market funds, which are rivals to banks, have got access to the Federal Reserve's pool of what are called reversed repos, and they can actually gain a higher interest rate, pay a higher interest rate to their depositors, and actually drag deposits away from these secondary banks. And that's pretty much what's happening. So at the end of the day, just read it as the situation is fragile.
Yeah, so from what I'm hearing, as you said, the higher interest rates have reduced the value of a lot of the fixed income assets, especially long dated, that these banks had, and then from there, they almost have to refinance even more in an already illiquid market. And if you get to the point where a bank people are worried about it, then that makes it even harder and harder.
Correct. Correct.
Yeah. So
Hence,
that's
there is a problem.
yeah, and that's what we saw. Yeah, SVB and Credit Suisse as well. I think that's why they had to be taken over. So if we look at, the Fed brought in that sort of facility where they could actually these banks could transfer the bond and get the full 100 cents on the dollar basically, compared to what the actual market price was for the year. Is this just kicking the can down the road, or do you think this is sort of resolving something?
Well, it's kicking the can down the road because the whole structure of the financial system is ultimately impaired. I mean, we've got a situation which is not, let's say, is not ideal. Let's put it that way. And these problems, these refinancing problems, have reappeared many, many times. What happened in the global financial crisis in 2008 was a rather magnified version of what we've just seen, but it was another example. What happened in the US bill markets in 2019 was another example of that happening. So what you're seeing is repeats of this same refinancing crisis. Look at what happened to the Eurozone banks between 2010 and 2012. Again, a refinancing crisis. This is the problem. The structure of finance is basically not up to the job of funding a system where you've just got huge amounts of debt to refinance. The problem is debt, but the issue is that what central banks have done to, let's say, manage the economies is to focus on the interest rate dimension, not on the liquidity dimension. So they basically still say, and you still hear this among regulators and policymakers, that QE or quantitative policies are bad, and what they've got to do is to get back to interest rate management. And that's, when I say dangerous, it's the wrong thing to be doing, because one of the things that central bankers did to get us into this problem was to slash interest rates to too low levels back a decade or more ago. And that was simply because they misread the entrails of the markets, and they basically saw evidence of cost deflation or evidence of deflation. And they misread that for a monetary phenomenon and not what it was, which was a cost phenomenon that came as a result of China. And as China was allowed into the world trading system in 2001, prices started to tumble of goods. And we saw retail price inflation come right down. And as a result of that, central banks panicked and thought, hey, we're going into a 1930s like deflation again, and therefore we've got to act here. So let's get interest rates right down. Now, that was exactly the worst response to make, because as you slashed interest rates, you incentivized more and more take up of debt. And so we've seen this escalating mounting of debt, which has caused the existing financial arrangements to become dysfunctional.
And what does high debt do? I guess to liquidity, does that just suck it all up to try and repay it, or how does that work?
Well, I mean, basically, another way of looking at this is that the problem is not a high debt to GDP ratio necessarily. It's a mismatch between debt and liquidity, because you need liquidity, balance sheet capacity, to refinance or roll over the debt. Okay, what we have is a situation where it's not that corporations are becoming insolvent and going bankrupt. Okay, obviously that may happen in a recession, but that's not what we're seeing. We're seeing liquidity crises. So you can't refinance the debts as they come up to maturity. That's the issue. And clearly the maturity of debts and bills and notes varies. Some may be of maturity of days, some may be months, some may be years. But you're continually having to face in the markets this need to refinance paper. And that's the problem. You need liquidity to do that, and there's not enough around. Now, this is again a slightly wonkish point, but it's a point that isn't still an important one, is that one of the things you see in bond markets are concepts called term premia, which are the risk premia that people normally measure on sovereign debts, okay, on government debts. Now, in theory, these instruments should be very low risk, okay, and in many cases they are. But actually, what the market is pricing in are big negative discounts to those bonds. So if you look at, in other words, look at the term premia on a US Treasury bond, it's not only negative, but it's actually the lowest value, the most negative it's ever been in its history. Now, that's telling you there's something seriously wrong with the system. And what it's telling you is there's a shortage of collateral in the system that basically creditors or borrowers need to use to borrow in the system. And they're trying to get liquidity, raise liquidity. They're using collateral, government sovereign debt as collateral, and there's insufficient around, which means that people are really paying up for it. So you've got negative term premium. And that's one of the reasons as well why the yield curve is so negative, is so inverted. It's a structural problem with the system. Now, hopefully, the policymakers and regulators realize this. I sort of get hints they do from time to time, but then we keep seeing problems.
Yeah, that's a great point. So if we go to the current, I guess, liquidity landscape at the moment, I know when we last talked, we and you said it, there is still that mismatch. But then I think in the start of the year, there was sort of an inflows of liquidity into the global market. So what are you currently, I guess, what's happened throughout this year, and then what are you currently seeing now?
Well, I think there's a number of things to address. I mean, one is let's look at it in terms of maybe two different sources of liquidity. One is, has the collateral situation improved? Because private lenders, for example, dealer banks, will actually use collateral, a pool of collateral to lend or to offer lending, okay, within the system. So that's a source of liquidity. Now, that has improved pretty significantly since the debacle of the UK bond crisis in September of last year. So one of the things to look at as a gauge of that is to look at the MOVE index. The MOVE index is the equivalent to the VIX index in stock market land for the bond markets. It's a measure of volatility across the US Treasury yield curve. And the MOVE index, which spiked at almost 200 on its index, has now come right down to levels of nearer 100. There's about 120, I think, when I last looked. And you would expect it to fall ultimately below that to get to about 80 or 90 on the index. That would be a normal reading for the MOVE index. So it's on its way down. And I think governments are actually deliberately massaging that volatility down. If bond volatility drops, collateral, the efficacy of collateral improves quite significantly. So that's one thing to say. Definitely there's a tick on that box, but you've got to watch that space. For investors, the most important volatility measure now is the MOVE and not the VIX index. It's always been fashionable to look at the VIX. VIX doesn't tell us very much anymore. I didn't think. The MOVE index tells us heaps. The other thing to think about is what the central banks are doing. Now, I think what you've got there is two principal central banks, or maybe 2.5 central banks that are operating. And when I say 2.5, I'm talking about in number one would be the US Fed, number two would be the People's Bank of China, and the half is the Bank of Japan, only in the sense not the Bank of Japan is unimportant, but its balance sheet size compared to the others is not anything like as big, and the yen is not such an international currency. Now, if you look at each of those in turn, let's work out in reverse. Japan is continuing to expand liquidity, and the new BOJ governor, Ueda, is basically said that there will be no change in current policy arrangements until inflation gets around 2% and pretty much sticks there. So I think what you've got is a policy that will persist in Japan, where they continue to do quantitative easing and expand the Bank of Japan's balance sheet. And that's for their own domestic political reasons. If you look at what's happening in China, despite the sort of widespread belief or assertion by many analysts that China was never going to ease again, which was very fashionable at the end of last year, China has embarked on a huge monetary expansion. to put that in context, in December and January, the amount of liquidity that the People's Bank of China injected into their money markets was about 10 times what they'd put in the previous 2 years. So there was a big, big injection of cash. That halted or faltered a bit in February, but it's picked up again through March and early April. So you're looking at evidence that China is continuing to expand liquidity, and it wants to use that credit growth to effectively goose the economy. And so what you're likely to see, as we sort of predicted last year, would be a very strong first half year for the Chinese economy, where it would likely surpass expectations quite significantly, which it seems to be doing. And I suspect the next quarter, or the current quarter, is going to be equally as good. In the second half of the year, the jury is out a bit. China may slow a little bit in terms of its economy, but it's very likely that the PBOC will continue to try and support growth through the rest of the year. So I think that you've got a situation where the People's Bank of China has got the money taps open along with the Bank of Japan. So the Asian picture looks to be pretty clear. If you start to look at the US is a little bit problematic because you've got the debt ceiling issue in the US, which again is a slightly wonkish conundrum, but it basically is saying that that the US is set limits, the US Treasury set limits on how much debt it can issue by Congress, and those limits are fixed. And every time it comes up against a debt ceiling, Congress has to vote for a new ceiling, and that has to be agreed. And that's just a constraint on the government spending too much and getting too much into debt. The trouble is it can cause problems when you get issues within Congress where the Republicans may want to be difficult about Democrat spending proposals, etc., as now. What you're seeing therefore in the US is a situation whereby the debt ceiling is approaching fast, okay? And it'll be very difficult for the US to issue more debt until there's a new debt ceiling which is arranged. Now, that could mean a significant deterioration in liquidity in the markets at some stage. There could be an air pocket. On the other hand, as we move closer to the debt ceiling, the Treasury General Account, which is an account at the Federal Reserve held by the Treasury, which is where it receives cash revenue payments, for example, from tax, will be run down, and that will essentially push money back into the economy. So you've got almost a seesaw occurring, or sawtooth pattern, potentially in some of these payments. It's a complicated issue, let's say. However, it would be wrong for the Federal Reserve not to take that into account. And so I fully expect the Federal Reserve will attempt to maintain the integrity of US capital markets through this period. And it may lean towards adding more liquidity and even postponing its ongoing QT program until the debt ceiling issue is actually resolved. The other issue, which is basically, again, a complicated one, but these things always get complicated around the inflection points or lower inflection points of the liquidity cycle when liquidity is tight, it concerns two other elements. One is the support that the Federal Reserve is giving to the US banks, either directly through the discount window or indirectly to support banks like SVB and others who might need funding. And they put in an emergency funding program for that, which has been fairly well taken up in terms of deposit assistance. So the Federal Reserve is clearly adding money through these channels into the markets to boost liquidity. And there is quite a lot of discount window borrowing going on as well in the US. At the same time, the holdings of Treasury debt on the Federal Reserve balance sheet are rolling off to an extent, and that gives the Federal Reserve cover to say, well, hey, look, we haven't changed policy. We're still doing a QT, but that really is smoke and mirrors. They're basically changing the goalposts here. They're trying to have their cake and eat it, if I'm not mixing metaphors, but basically saying, look, we're letting bonds roll off, but actually at the same time, we're adding liquidity to the system. And the best test of that is to look at what's going on with the level of bank reserves in the system. That's a pretty good guide to Fed liquidity injections, and they're now well above $3 trillion US, which has really been the critical threshold below which, if reserves fall, you tend to get tensions in the system. But it's got to be watched closely. If you get a dip in bank reserves below 3 trillion, then you're going to have tensions in the markets. So this is an issue to address. And then the other question is the reverse repo account, which again is a bit of a wonkish concept, but that basically is a detraction from liquidity in the system. It's basically the Federal Reserve offering very, very generous terms, particularly to money funds, to absorb their cash deposits and take liquidity out of the system that way. That's now about 3.7 trillion. It's come from nowhere, so it's absorbed a lot of liquidity in the US markets. And that's why it's actually wrong for people to say, as actually some Fed officials do claim, that the reverse repo is a testimony to the fact there's lots of liquidity in the system. It's not. It's actually a testimony to the generosity of the Fed in offering such high interest rates. It says nothing about liquidity. In fact, it's a detraction or withdrawal of liquidity from the system. So what you've got, bottom line, is that since September, collateral has improved. Secondly, the People's Bank of China and to some extent, the Bank of Japan have added liquidity, and the Federal Reserve's reserve levels have actually increased significantly since last September, partly because of the UK gilt crisis, where they flatlined after that, and now since SWB, where they've jumped higher by about $400 billion or so. So all three boxes are ticked. So that's been a big boost to global liquidity. The issue is now, we could be seeing a possible air pocket if there are problems in the US in the near term. That's possible, although I would suspect that the Federal Reserve is going to weigh in and tackle those. The bottom line, in our view, is that you've already had the inflection in the global liquidity cycle. That was last October. Liquidity is bottoming and picking up, and it's likely that the next big peak in liquidity is 2026. So as far away as another 3 years. So you should be seeing essentially the wind behind investors now, rather than facing the sort of gale force wind of monetary tightening in our faces for much of the last 15 months. And I think it's very important when it comes to investment to look not tomorrow or today, but to try and look about 12 months hence and try and think about what the monetary environment will be then. And I think it's going to be substantially better than it is now. And therefore, you need to be thinking about taking on more risk progressively as this year unfolds, despite what economists say about upcoming recession. That's something that we may get, but I think the markets are cleverer. They're going to look through this.
Okay, so with the increasing liquidity you expect, as you said, in the coming years, we probably won't have that refinancing issue, or is that still going to be something that we should?
Well, I think it's look. I mean, make no mistake. The refinancing issues are a structural problem that are not going to go away. Okay, but what they necessitate is continual central bank activity to add more liquidity to the system. Okay, now that's the reality, and that's what we've seen several times before. So QE is not a luxury. QE is a necessity, and QE is not cyclical, it's structural. So it's going to come back, and it's going to come back in size. And you've also got the added issue that is a real one, which is how do you fund governments in the medium term? And the only route you've got, maybe conveniently or inconveniently, whatever, how you look at it, it's the central banks that are going to be providing that finance. Now, that actually helps them on the role of adding liquidity to the system, because they can do both things at once. They can help to fund the federal governments, and they can actually push in liquidity at the same time. So what you've got is effectively a kind of a neat solution. But the scale of the potential take-up of government debt by the central banks in the next 10 years is eye-wateringly large. And so, we're now looking at a Federal Reserve balance sheet of about $8 trillion. But if you take the Congressional Budget Office forecasts in the US of what the debt load of America will be by 2033, the Fed balance sheet could easily be well over 14 trillion and maybe even testing 15 trillion. I mean, such is the problem.
Yeah, that's an amazing number. So I guess before we get to that stage, you mentioned there could be some air bubbles in the system. Would those or air pockets, sorry, would those sort of be the like what we saw in 2018, where there was that issue in the repo markets? Is that sort of what you're thinking? Or I guess SVB could be a similar. Is that what we could see?
Well, I think it's difficult to predict the actions of others, particularly when you're talking about politicians and central banks, because in many cases it's not joined up thinking. But the reality is that we're moving from A to B. A is the bottom of the liquidity cycle. B is the top of the liquidity cycle. The bottom was 2022. The next peak is 2026, and it will not. I'll guarantee it's not going to be a straight line up, but the direction of travel is basically from A to B, moving up the cycle. And what that normally tells you is you buy dips, you grit your teeth and buy through these periods, and that's what I think we're basically in. And as to the recession fears, I mean, I'm not discounting the fact we may well have a moderate economic recession. That's not impossible, not least because if you look at interest rate sensitive areas of economies, they're clearly feeling the heat of higher interest rates. But stock markets or investors don't only look at the business cycle, they also get spooked by inflation fears. And I would argue that if you've got a situation, maybe more spooked by inflation fears, and if you get an environment where the inflation rates across the West start to tumble, partially the latest result in the UK, which clearly wasn't helpful. But if you look at bigger economies and more important economies like America, Europe, or Asia, you've actually got, I think, pretty compelling evidence that inflation is coming down. You could argue it's sticky, but the direction of change is definitely downwards. So if we reach a situation by the back end of this year where central banks' targets are much, much closer to being hit, I think equity markets will see a significant upward re-rating. And that's not what is being factored in right now. They're tiptoeing towards that conclusion, but they're not there.
Yeah, it's really interesting because I guess a lot of people are probably thinking, you said that the Fed balance sheet is probably going to close to double in the next 10 years, at least for predictions. And there's going to be, large deficits. And there's going to be lots of investment in the economy. A lot of people are probably thinking that that means high inflation. Potentially the Fed has to stay tighter for longer. Is that the case or?
Well, I think the answer is that to that question is you've got that what you've got to distinguish here is the difference between high street inflation and monetary inflation. The two are different things. They can be connected. But the factor that connects them is cost inflation or cost deflation. Now, if you look at the history of capitalism, capitalism is extremely efficient at reducing costs. And we know that. Okay, it reduces costs by technology or by more efficiency or whatever it may be. So in the long term, you tend to find you get cost deflation. But you always get, because of the growth of governments, monetary inflation alongside. So you've got these two parallel, forces which are sort of diverging. Cost deflation is pushing the price level down the whole time, but monetary inflation is pushing it up. High street prices are a cocktail of these two elements. Okay, over the long term, the price level is determined by monetary factors, but in the short terms, which can be 3 to 5 years, what you can see is that cost elements such as oil prices or labor costs or productivity can actually interfere with that picture quite significantly. So my view would be that inflation in the medium term is higher, but I think it's going to be very volatile. And I think what you've got is the potential for inflation to come down, maybe temporarily, by the back end of this year, but potentially substantially. And that may fool people into thinking we've got a low inflation environment. And that could cause an equity re-rating. And then what you see is then maybe another episode of inflation. But at the end of the day, what's driving asset markets over the medium term is fundamentally more monetary accommodation, more liquidity. You don't necessarily want fixed income markets in that environment, but you probably want some money in equities and you want some money in hedges against monetary inflation. Traditional things like maybe real estate, maybe commodities, maybe gold, precious metals, potentially cryptocurrencies, all these things which can act as hedges against monetary inflation.
Yeah, it's really interesting. And yeah, you've been mentioning that you mentioned a few assets there, but From what you're saying, 2026 could be the peak of the liquidity cycle. So from, there'll be ups and downs, but from there, really be, I guess, similar to what we've seen in the past. Is it where the assets that are probably have the highest risk premium are going to perform the best? Is that sort of what we could see?
Yeah, I think what you want is you want basically you want instruments that are likely to be sensitive to more liquidity, which comes down to what in sort of finance parlance is long duration investments. In other words, investments that have a long payoff period. So that's things like technology stocks, equities probably in general. Technology, as I say, does well in that environment. Gold, real estate, those are all long duration investments. Crypto, another example.
Yeah, it makes sense. And as you said, if the Fed were to pivot in this year at some time, that would just be a rocket underneath the markets.
Yeah, and I think the other thing I think one's got to be realistic about is the plain fact: does anyone really want a recession this year? Okay, it's not in many countries' interest to have a recession, particularly the US. If you've got Biden trying to seek re-election, why should he engineer a recession that's going to hit just at the wrong time for him? Presumably, that's not going to be good. And then if you dig deeper into this thought, you say, well, actually, could it be possible the West has a banking crisis in 2023? If it did, that would be a huge gift to China. Well, why would they ever entertain that? So I think that what you probably got going on now behind the scenes, who knows, in truth, what you've got are central bankers and regulators going around to make sure that the system is actually stable enough that it doesn't deliver that sort of shock to the system.
Yeah, it does seem if you compare, I guess, Credit Suisse to Lehman's, that they've decided they'll do whatever it takes to keep the system afloat, be it not just using interest rates, but using whatever tool they can create
Yeah,
legally, or not even legally. They can just make it up and go from there.
yeah, exactly,
Yeah,
exactly.
perfect. So, Michael, thanks so much for your time today. I really appreciate it. I guess my last question is, what is one message you want people to take away from our conversation?
Well, I think the one message has to be you've got to watch liquidity because liquidity is so often the key factor behind market movements. And for so long, textbooks and commentators and pundits shunned the whole idea of looking at liquidity. But what the QE and QT, the quantitative easing and tightening programs of central banks have highlighted very clearly is how important liquidity is. We here have always thought that, and that's how we've essentially run our books. But now everyone's got the opportunity to see how important liquidity is for markets and to watch what is important, and so to avoid the mishaps that potentially are out there, but also to gain from periods when liquidity is strong, which we think is upcoming.
Yeah, it's a good thing and not a bad thing. As a lot of people think that more liquidity is worse for I guess the economy knows that's not the
Yeah,
case.
not necessarily so.
Yeah, perfect. So, Michael, thanks again. So, if anyone wants to find more about your work, I know obviously CrossBorder Capital, and you've released some great books that I enjoyed reading. Are those best places people can find what you've done?
Well, Twitter is maybe an obvious sort of starting point. So our handle is CrossBorder Cap. We're on LinkedIn. We've got a website, which is crossbordercapital.com. And if you want to read all about liquidity, I published a book a few years ago called Capital Wars, which is actually all about the current environment in actual fact. And that's published by Palgrave and is available, Amazon or wherever.
Yeah, perfect. I'll put that in the
Thank you.
description below, but thanks again.
Good. Thanks again.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.